Okay folks, welcome back. Alright, so this is the price action model number 2. This is going to be specifically dealing with short-term trading. Now the model I'm building it on is weekly range expansions. Okay, for the short-term weekly range price action model number 2. This is going to be more or less how we break down the overall price action models. The point of these are not so much to overcomplicate it and to reteach the mentorship, but kind of like pull certain segments of the content in logical locations for the premise behind each component. Here, as you can see, I've given us a model of a stage, a setup, and a pattern. And specifically, on a larger perspective, the stage is going to be our weekly direction. That means we have to have a directional bias for the weekly candle. Okay, and the setup is going to be our range expansion. And our pattern is going to be based on the PD array matrix and looking for opposing PD arrays. Okay, so we're going to be looking at the concept of range expansion, and these candles are crude depictions of a weekly candle. And on the left hand side, we're seeing a crude depiction of a weekly up close, and the open is going to be specifically referred to in this model. And you can see here for the bullish weeks, what we're going to use as a context for the draw, or why we believe that the weekly candle should go up, is it's going to be targeting a buy stop liquidity pool, or an old high, or a fair value gap above where the market opens for the week. Conversely, when we're bearish, we're going to be using just 3 PD arrays. Again, the fair value gap, old low, sell stop liquidity pool. Really simple. Okay, so what do I mean by this? What's the context of what I'm showing you here? Obviously, we went through a lot for the mentorship, and I'm limiting our focus to this model to only looking for fair value gaps, old highs and lows, and the liquidity pools resting beyond the old high or low. So our understanding is we want to see when the market is relatively bullish. We'll be opting to use the model for our stage, if you will, on the left hand side here with the bullish up close expected. When we're bearish, we're going to be using the model shown to the right when we're expecting a down close for the week. It can be one of the 3 PD arrays. The fair value gap, in other words, an area where price needs to be rebalanced on the weekly chart, an old high or low, where it may retest or reach up into a order block or below into a bearish order block. Now the order block itself is not being delineated here or mentioned as the PD array, but you can substitute the old low with order block. And then obviously the liquidity pool that will be resting just beyond a short-term old high or low. Alright, so we're going to be looking at a bullish example here, and you can see here on the right hand side, this is a weekly chart, just so you know, it's the weekly chart of the dollar CAD. And I'm using this example because it's something I traded. You guys seen examples of it, you've seen executions as well, so everything here is based on something I actually did. So right away we can see that there's equal highs in the dollar CAD pair, and then right above it we have an old down close right before the move up. So only buy side delivery has been offered. It's that blue line. So there's an old reference point for institutional order flow and a fair value gap that resides, and that is seen here. Okay, so only sell side delivery has been offered from this point on down. Using this area here, the open on this candle, trading higher. So I'm framing the fact that we only went down here. This candle went up to this price point, left this inefficiency here. So our fair value gap is the draw. That's what's causing our bullishness or view for the dollar CAD in this example, why we expect it to go higher. And also, we have a liquidity pool here as well with an old high. Okay, so we have old high, liquidity pool, fair value gap. Okay, so we'll take a look at what transpires as a result. Okay, price trades up into and fills the fair value gap right there. Okay, and again, this is the setup. We're looking for the weekly candle to do this very thing here. Now you can see price does in fact open on this week here. And again, these are weekly candles. You open, it trades down a little bit and goes higher. It opens, trades down a little bit and goes higher. This week here, it opens, does move a little bit, but eventually you would have been stopped out on this particular week. And then we have the really big bullish candle that takes us right up into a rebalancing of the fair value gap right here. Okay. Okay, so let's take a look at what is the opening price for our price action model for this. Now, obviously, we can use the Sunday's opening price, or we can use Monday's opening price, okay, at midnight New York time. Or we can use, in this model, we're going to be using the opening price on Tuesday. Now, why am I going to be using Tuesday? Is because Tuesday typically will create the higher low of the week, but we do not require having that level of precision if we're going to be short-term trading, because the logic I want to build into this model is you don't want to be sitting in front of the charts all the time, but you do want to capitalize with some measure of intraday price action. And the way we're going to be using that is we're going to use the opening price on Tuesday at 400, and we're going to use that time so that way we don't ever have to worry about going back and forth with daylight savings time. Okay, so if you use that hour, you don't have to toggle anything. Just keep it like that all year round. Just leave it. Okay, and the idea is that opening price, which is being delineated here on this particular week, and this is Tuesday's trading, that opening price, when we're bullish, we want to be buying at that price or below it. Now, if you're going to be rather lazy and not be up during the London session for entry, what we'll be doing is we'll be buying at that price and then using a 50 pip stop. Really simple. So all you have to do is find out what time it is in that 400 hour, and if it happens to be online with 12 o'clock midnight in New York time, or if it's a little bit earlier or whatever, long and short is you don't have to worry about that measure of precision because we're short-term trading and we're using it as a filter. Okay, so when we're bullish, we're going to be buying below this price level. Ideally, we want to see what would be residing below this level in a form of a discount array. We could look for a short-term swing low, as we see here. Short-term little swing low here. Price does in fact go below that. So you could put a limit order at that low, or that low plus 3 pips, or 5 pips rather. And then at that price point, then use a 50 pip stop below it, okay, as your protective stop loss. And we'll be looking for an expansion on the week, and because we don't know always if it's going to be a tiger by the tail that we've caught, we want to have some factor of time involved. So while I'm giving you the price element here and certain measure of time because of the Tuesday, we want to be holding on to the moves until Thursday New York open. Okay, so between Tuesday and Thursday, that's the bulk of the weekly range. And we want to be at least minimum hold until Thursday's New York open. Okay, so what is the pattern? At the 400 candle, that opening price, we want to be buying under that on Tuesday or Wednesday. That means if we don't get an opportunity to trade below it on Tuesday, then we wait until Wednesday. Wednesday may, in fact, not give us an entry as well, but if it does trade below it, we will be looking for an opportunity to go long. We will use a 50 pip protective stop loss on our demo account. And again, we're going to be holding for New York open or stop out. And again, the idea starts on Tuesday. We do not trade on Monday in this model. The ideal draw is again on the weekly chart over here for why we believe the price should go higher. Again, this would be delineating an intraday perspective on Tuesday. When we're bearish, again, this is the weekly candle here, delineation with fair value gap, old low, and sell stop liquidity pool as our discount arrays for the draw on the weekly candle. This opening price in here, what we're utilizing is the idea of power 3 on the weekly chart, and we're going to be looking for, now this opening is not necessarily what's going to be derived on our weekly chart here. This may in fact be something down here. In other words, this opening price here may be a little bit lower in the weekly candle, which is fine. We don't necessarily need it to be at the very, very high. Again, with this model, I'm building the idea that we're using the highest probable day of the week, which is Tuesday and or Wednesday. And the idea is we want to know where the weekly chart is most likely reaching for. Now think about it. Instead of trying to day trade and we're trying to figure out multiple candles intraday to see where it's going to go, we're only looking at a weekly candle. It's either going to go higher or lower, or it's going to sit sideways. If we are studying price on the weekly chart and we can see that these levels down here would be obvious candidates to be filled, then we're waiting for Monday's trading to give us an insight whether or not this may or may not come to fruition. Ideal scenario would be this whole move up and then we traded below it for Monday. Then if we see a similar scenario where we open at the 400 candle on Tuesday and then rally above it, we could be a seller above that price level, use a 50 pip stop loss, and just aim for Thursday's New York open. That's our first objective. It doesn't mean collapse the trade entirely. It just means that that's our first minimum objective for time and price to meet. So we're going to try to get the bulk or the lion's portion of the weekly range between Tuesday and Thursday. Again, we're going to hold for New York open on Thursday or stopped out. Okay, so what's the logic behind this entire model? The weekly range, when bullish, will likely see a strong up close on Tuesdays. We do not need to capture the Monday low of the week if it forms at all on this model. Now, when bearish, we do not require the Monday high of the week either, should it form as well. We are seeking the range within or inside the weekly range between Tuesday, 400 candle, opening price, and Thursday's New York open as a minimum objective for time and price theory. Now, your homework is to go through the charts and find scenarios like this where it allows us an opportunity to capture some expansion either when bullish or bearish using the weekly candle, because we're short-term trading, so we're going to be focusing primarily trading inside that weekly range. And our time frames for this model are obviously the weekly candle or weekly chart, the daily, and we're going to reduce it down to the 1 hour. Now, for timing purposes, you can use a 15-minute time frame instead of an hourly chart.
Okay, folks, welcome back. So this is a amplified teaching on the price action model number 2, short-term trading. And we're going to talk about intra-week or intermediate reversals. Okay, building on the premise of the short-term weekly range strategy that we built for model number 2, we're going to open up with a stage of weekly direction. Now I'm going to throw you a curveball here, but this is what you want to know, because not always is institutional order flow going to be remaining bullish or bearish. It's going to be met with some measure of resistance or significant support. It's going to cause a shift in momentum, and you need to be prepared for that. So the reversal condition is our setup, and the pattern is the European Open. All right, so we talked about how on the weekly range we're expecting a bullish week. We want to see the open here, and the expectation is we're going to see a higher close on the week. But what happens if this week, or this particular range, is the previous week, and it trades up into a level of stiff resistance, or maybe it trades up into a important premium array? Remember, if we're expecting price to trade up to that level, it's going to be many times an opportunity to reverse. Now, we used this theory to build the idea for a technical target or something to reach for or draw on liquidity. But what happens once we get there? That's what we're going to focus on here. On the right-hand side, you can see equally when there is a bearish scenario. Let's say the previous week we trade down into the actual objective we were aiming for, and it happens to be a intermediate term or long-term discount array. Well, we can expect a reversal of sorts, right? So at the time of this recording, we did a pre-week analysis video, and we incorporated the likelihood of a seasonal tendency for the dollar index to decline and the euro dollar and the British pound to rally. It's Wednesday of this particular week in February 2019, and it's been shown that the euro dollar and British pound have in fact rallied with a weaker dollar. Couple that with some of the things I'll talk about when we get into technicals for the charts. If those two currencies are suggested to go higher seasonally, and they have reached significant discount arrays, one would assume that there's a likelihood, with the seasonal tendency incorporated, dovetailing with a weaker seasonal tendency for the dollar index, that all foreign currency should find their way higher, because the old adage is all boats rise in rising tide. So that means if the dollar's weak, there's a likelihood, very, very strong likelihood, that even the weakest of currencies still has an advantage in finding some support or finding its way higher as well. So assuming that we're watching basically over here on the right hand side, say this was our objective, we were looking for this to be traded back up into, but what happens when price trades up to that level? Okay, so in other words, we've had weeks, okay, if this is a weekly chart here, say we've aimed at this one and price eventually gets up there, okay, so our buy stop, liquidity pool, or old high, or in this case an old low, okay, or a breaker, because that's what this is here, this represents a breaker, we could trade up into that level and anticipate again some weakness to come into the marketplace. But how do you go in and gingerly get in there and try to sell short? Well, you have to wait for certain things, and we're going to talk about that now. So as price slams up into this price level here, we're going to be looking for a specific filter for our trades, and it's going to be the European Open. We do not want to go in here and just simply sell short on any old price level or on a whim. We're going to be looking for something to really solidify the likelihood of this market wanting to go lower. We're going to use market structure to help us do that. So obviously you see an example here, and I'm not going to use this example so much for this teaching, but when price gets up to this level here, this many times can be a shorting opportunity, especially if it's based on a higher time frame premium array. Obviously, we mentioned how in this crude example, it could be used as a weekly breaker, bearish breaker, and then we could look for signatures in price action to build a model that will allow us to go short. So what helps me build my confidence in selling short or buying a market that is in a reversal condition? Initially, we gave you the idea of using Tuesday as our entry. But what happens if Tuesday doesn't really give you an entry? What happens if Tuesday is the actual turning point and then there's a break in market structure on that Tuesday? Well, then you obviously can't do anything on Tuesday because you didn't get the setup until Tuesday's formation. So that leaves Wednesday and Thursday for this model. Remember, the criteria for this model number 2 for short-term trading, the weekly ranges, we're going to be looking for a Tuesday entry, not trading on Monday, but looking for a Tuesday entry, holding through Wednesday, and a minimum hold objective until Thursday's New York Open, aiming for about 50 to 100 pips. We're bringing in now the element of a reversal market profile. So if we have this as a potential scenario, how do I go in there and trust these types of setups and not get burned by an existing trend that continues on higher or lower? In this case, we gave you the Tuesday, so we're using standard time, Eastern Standard Time. We're not using daylight savings time. I don't want to use daylight savings time. I don't want you thinking about daylight savings time. So when we have daylight savings time shift in the U.S., some other countries they observe it too, but not all of them. Okay, so one of the things I learned by studying time is that there is a real secret to how these markets work by just ignoring daylight savings time. Don't even look at it. I think that it creates a problem for certain individuals that are focused on specific things with their systems, and I think it helps the algorithm disrupt those traders that have a specific time-based structured approach. So from a central bank standpoint and how the algorithm delivers price, IPTA, the interbank price delivery algorithm, we use a standard 400 opening price. Now, in standard time, Eastern Standard Time, that's going to represent the midnight candle in New York. When daylight savings time shifts, it becomes the 500. I don't care about 500. Okay, I'm staying on 400 because other countries are not going to observe that. So even though there may be a lot of times where the 500 opening price will serve you well, I don't care. I'm sticking to this. This is a constant. Okay, but what happens if we see a price level trade up into a level right into this suggested target? If that is a premium array, the criteria over here of buying, okay, we're not doing that. We're going to be looking for a shorting opportunity. So when price trades up into the objective that maybe we've been following for a while, but what happens when we hit that target? Are we done trading? No. We want to look for signatures that will allow us to go short, especially if it is a monthly or weekly premium array. So we abandon the buy under 400 opening price on Tuesday or Wednesday using a 50 pip stop loss, holding for Thursday's New York Open or stop out. We're changing that to we're looking at the 600 European Open, and we're going to be selling short above that price level. And I know it'll make more sense when I show you the examples later on in the video. But once we get to this level, if it's a long-term or intermediate-term premium array, we don't want to be continuously buying that. We want to be sensitive to the likelihood of it maybe having a reversal. So I'm going to give you the criteria that I use to help me get in there and not try to stand in front of a train. Inversely, when we've expected the market to trade down here, like we've taught with model number 2, once it hits that objective, are we done trading? Are we going to continuously looking for lower prices? it may not provide that to us. So we want to be anticipating, or be like we opened up last week in our analysis, before this week even started trading, the expectation was that we could potentially see a reversal in the marketplace, because seasonally things were there. And we had some Brexit news also expected this week. So there's a lot of things, a lot of ingredients came into this particular week that helped us frame the likelihood of an upside reversal for Eurodollar and especially GBP USD. So cable, having had the Brexit vote on this week's Tuesday, it helped us frame the idea of this intermediate term or intra-week reversal. It just so happened that Monday started right out the gate higher for GBP. But once we trade, let's assume that we trade down to that level and that our objectives have been met. We do not want to continuously follow this model over here, which is selling above the 400 opening on Tuesday or Wednesday. We don't want to do that. We want to be changing gears and using, again, the 600 European Open. But now, not selling above it, but looking to buy below it. If we get a market structure shift on this week, say it happens on Monday. Well, this happened to happen this particular week, at the time of this recording. So with that Brexit instilled fear or excitement about trading the GBP USD pair, along with the seasonal tendencies with the dollar index wanting to go lower, traditionally not, again, it's not a panacea, but hopefully you see the blending of all those things this week. Before the week even opened up, we were on red alert, okay, that this thing could reverse and scream higher. And come to fruition, several hundred pips, this GBP has exploded to the upside. Dollar has weakened. So the premise is once we get to our objective using model number 2, we don't abandon model number 2. We can now still use model number 2 with the reversal market profile. Okay, so let's take a look at examples of how we can use that. Okay, so we're looking at the dollar CAD pair. And let's zoom in here and get a little better perspective on what we're looking at. Now, a few weeks ago, I gave you a chart with the daily suggesting that we were going to work within this range up here. And right away, I'm just going to show you this low. Okay, this low comes in at 134.68. Okay, so 134.68, and prior to the run up here, what would be the nearest price level using a 5 or a 0 level to that 34.68 low? So 134.68. Again, we don't look at the pipettes, though. So just ignore that number 2 after the number 8. So 134.68, the nearest 0 level or 5 level under that level would be what? 134.65, right? So we're going to take 134.65. That's going to represent a key level. Now, why is it a key level? Well, if you look at this very section of price action right here, inside of that little nodule in price action, that means right in here, this little segment of price action is going to be significant because we're going to look at that when we drop down to a lower time frame. I'll be able to zoom back, and wherever this blue section is, you'll see what I mean by this being balanced. Price traded aggressively lower. We bounced around in here between the close, the low, and the high, and the open here, and then broke below this low on this candle. And then we had an imbalance. So we had a SIBI, sell side imbalance, buy side inefficiency. So it's stretched out, pulled out really, really long on the downside, and we would reasonably expect some measure of up move into that price level here. Okay, so we have the inefficiency here that gets rebalanced here. So what does that make this little segment of price action right there? That makes it obviously a target. We were looking for that on the upside. But more specifically, once it trades to it after refining the price level, okay, we are not ambiguously looking inside this range clueless, we use institutional pricing models to get to a 5 or a 0 level. Again, the 134.65 level is a calibration of the nearest 5 or 0 level below this candle's low. Okay, for instance, if this candle's low was 134.64, what would we use? We could use 134.65 still because there's only one more pip, but to be fair and more refined, it would be 134.60 because it's the nearest 0 or 5 level. Remember, going up to that price level. So since the actual low was 68, let me put it back up here. Since the actual low was 68, 134.68, we're going to be using the 5 level. It's closest to it, okay, but not over. Okay, so we're rounding down. If we ever coming down to a particular price level, we're going to round up to the nearest 5 or 0 level. Okay, so there's your simple rules for you. So we calibrated the price level. Okay, now we'll look at this when we drop down in the lower time frame. But when price hits that, how do we know when we can operate on a short basis, okay, or a reversal market profile and not get burned by a potential run up? Well, there's always going to be some measure of risk in anything we do. And reversal patterns, that's why I waded so deep into the content before I started talking about it, because it requires you a great deal of the foundational studies and the core content of the mentorship. Because if you just go in there and willy-nilly an entry based on you thinking it's a high or a low, it can hurt you. And then obviously you'll be putting tweets on Twitter, like I read last week. Some guy more or less faulted me for him not making money in his oil trade, even though oil traded to 58 today. So again, I'm telling you where it's going to be drawn to. I'm not telling you, by the time and the date. I'm not doing that. So I want you to be responsible and accountable for your own actions. Again, that's the reason why I teach in a demo account, period. That just sells us the whole reason why I do this in a demo is for that particular reason right there. It's so easy for everyone to say, well, it's somebody else's fault. It's not. It's not my fault. It's your fault. I don't tell you to get in these trades in a demo account, and I certainly don't want you to with a live account. If you do it, you've done it on your own. I'll get off my soapbox now. So we have this price level here. Okay, now before we drop down, when price is moving, if we see a reversal here, let's assume that we're right in the assumptions that this is going to create a reversal. How far can it go down? Well, let's map that out. We have a balanced price point here, and I'll explain that as I go. Then we have all of this inefficiency, so that's another one. Okay, and I'll just extend this a little bit more. And right below here would be a liquidity pool. So we'll have that noted as well. And we'll just make that a different color just to draw a distinction. Now, obviously, the color schemes, whatever floats your boat. I'm not here to try to sell any one thing better than the other. It's a matter of preference or whatever. So we have these equal highs here as well. Now, obviously, we've traded through that, but that's also a level that's up close right here. That would be one I'd be watching, and that comes in at 33.16, which in this case would be rounded up to 33.20, or you can be a little bit of a deviant and use 33.15 because it's only one pip. So that'd be a level I'd be looking for, but we're going to work with this here. This is going to be sufficient. Now, what makes this high important? Because you're probably thinking, wait a minute, you just skipped over, you're not going to come back to it. This candle, we traded up and then down off the high. So we had a little bit of a wick there. The next day, we trade up through that. So between this high and this candle's low, that is essentially what we got over here. It's a balanced price range. So again, I'm going to use this little price nodule right there, and I'll just extend this out down to that low because that's going to be the context of that balanced price range. So if we get through that, it's going to be significant. That means we can now target the lows down here. Okay, so let's go into an hourly chart and take some of that out of there. And here is that balanced price range. Okay, so we had movement down, then we had movement up. So this is essentially a balanced price range. Okay, really nice price range. If it trades down below that, that's a significant indicator that we could probably look for a run on liquidity below old lows. Well, what you know it, we have equal lows here, and then we have a little bit of a gap. Okay, so now dropping down to an hourly chart, we now have another level, and then we have a down close candle, which is an order block. So whenever I have this cascading effect of discount arrays, we have a liquidity pool, void, order block. I'm going to elect to use the order block first because that's where the last delivery on downside was, or sell side delivery. So I'm going to look at that as a primary driver, and it happens to be 132.40, nice round level. Also, it stretches below the 132 mid-figure 50. Now, it doesn't mean that it can't hit this high here and stop dead in its tracks at 51.5, which would be 55 calibrated. And again, since it's only one pip away, 132.50 could still be used in this instance. Below the lows here for the liquidity pool, we have 32.75. That in itself is enough. It's a 5 level. Or we could do 132.70 because we're going to be reaching now. Again, we want to open up, not round up. We want to round down because we're going expectedly below these lows to seek liquidity for stops. Okay, so anyone long all through here, maybe they kept their stop loss here, and that would be potentially in jeopardy. The levels that I highlighted already, you can see the sensitivity here, intraday today. I had a real nice little run up into that. I gave you a criteria for looking for institutional order flow entry drills. Okay, so how do you pick your entry points? Well, I want to go inside this little area here, and we'll come back to that. Let me go back up here and build this model out. Price hits it here. Let's put the day dividers in. Okay, so this is last Friday and last Thursday. So last Thursday we hit that level. Friday we hit it again, fell short of it here, and then bang. Here's our market structure break right there off of a key level. Okay, now again, this level is that daily level where price has essentially been rebalanced. So if we have this short-term low here prior to the run up into that key level, this low, once broken here, I do not need a close below. See how it wicked through that? That to me is a break. We're not looking for any down close requirements. It broke structure right there, bang. We consolidated around it, then broke down one more time, then came back up and hit it as resistance. So this level here, cutting through all these candles, I have to straighten this up. I learned this new trick. And for the life of me, I love it. So for the guy that shared it with me, thank you very much. I love it. So we hit it as resistance here and then sold off yesterday. And then today we had consolidation and then dropping off. The way I use reversal pattern entries, I don't teach this in the free tutorials. Okay, so this is one of those moments where we go beyond free tutorial stuff, as you would expect in Charter Member. So we have last Friday a break in market structure, and then Monday, small little consolidation, a run up, right in here, equal highs, pokes through, there's a shorting opportunity right there, breaks down one more time, shorting opportunity here, and then right in here we're going to talk about how we can use a short as well. But we have to ring in the European Open to do so. So I'm going to drop down into a 15-minute time frame so we see the price action over Monday, Tuesday, and Wednesday. Now I want you to take a look at this. Pause the video, okay? Pause the video and look at what you see and understand right now based on the level of content you've gone through for the mentorship and maybe in the free content. Look at what you understand now, okay? And then unpause pause the video and you'll hear me talk more about it. But don't listen. Do the exercise of pausing it and see what you see and outline what you see in price action, and then I'll continue on when you hit the unpause. I know some of you didn't hit pause. So looking at what we have, with all these levels in here, actually these levels are going to disappear, but I'm going to give you, so now we have a institutional perspective. We have Monday's trading in here, which we don't trade on Monday, remember? There's no Monday trading. So we're not going to worry about anything on this particular day. On Tuesday, we have the European Open, which, again, we're using 600. That's this candle here. Okay, the opening price, 133.58. We take that on the 600 candle, and then we extend it out in time. Now, you can extend it out to 9 o'clock in the morning. I like to do that generally because it just helps me filter out any little additional spikes that may fold the market over based on a New York news embargo lifting for the news at 8:30. Okay, so I extend it through that point. But what we're looking for is the way we interpret the Asian range. Okay, the standard protocol for this is if you want to be a seller on weakness. So in other words, you say you're a trader using my concepts and you want to use sell stops for your entries on shorts. Okay, you don't trust your analysis on picking the high or how far the Judas swing is going to go. You just know that the bias is really, really bearish. You don't want to overthink it. You just want to put it on autopilot and be done with it. The way you can do that, especially using Model 2, is the Asian range theory is if we break below that, the idea should be it just continuously goes on and on and on for the daily range to be completed. But if we have the bearish bias, which is what we would have here based on previous week, this is a little too zoomed in, actually. Here's Monday's trade, and here's Tuesday. Here we are. The expectation is we want to see price move out of the Asian range like it does here. So if you extend the Asian range out, and I really don't want to do it, but I'll do it for the sake of completeness. You extend out the Asian range like that, and how I did that is I highlighted it, just hold down Shift on your keyboard, and then drag the line out. It'll keep it straight and it'll allow you to elongate it. So if you want to sell on weakness when you're bearish and you don't trust how far the Judas swing is going to go, if you start seeing price rally like this, okay, all you have to do is go right to the Asian range and put a sell stop right below that. Okay, and if it hits it, it fills you. Once you see the rally up, okay, once you see it rally up, that high, all you have to do is go right to the low of the Asian range, put a sell stop there, and then use the high of the day at the time of you watching the Judas swing unfold. That's going to be your stop. Now, as the price keeps going higher, 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 your stop still remains below to get short below the Asian range. You would just open up your stop a little bit more and more and more and more. But eventually, at some point, it may change your leverage based on the percentage of risk. So you would need maybe sometimes drop down from maybe 2 minis to maybe 1 mini or maybe 1.5. Okay, if you're allowed to use that type of leverage. Or I guess a better example would be using 2 standard lots and then maybe 1.5 or 1 standard and 5 minis versus using your original 2 standard lots that you want to sell short on a stop here. If the swing starts to project too far beyond what would be reasonable for money management purposes on 2 standard lots, then you may have to drop down to 1 standard and 5 minis. Okay, so that's why it's important you go to a broker that will allow you to trade in minis and not force you on standard lots only. It may not be such a big deal now today, but years ago that's how it was. They made you had to trade only a standard lot, and then you don't want to do that. But the beauty is once you get the Asian range defined, you just wait for that breakdown. Now you're probably thinking, wait a minute, now you're teaching us breakout trading. No, I'm teaching you a lazy man's entry approach. It's confirming when you have the bias right, but also it's still a structured concept because it gives you the ability to know where your entry is and not have to worry about being precise about how far it goes up. In this instance, if you want to be expecting the Judas swing to form, how much market protraction should take place, you can obviously see during this particular day, Tuesday, yesterday, we had a nice consolidation during the Asian range, unlike what we saw here on the central bank dealers range. So using the smoothest portion between the two, or if it's allowed, flout, okay, but in here, Asian range, one full standard deviation up gives us 134.16. Again, forget the pip, the pipette. So 134.16. The actual high forms at 134.16. Perfect. Okay, so you could be a seller at 134.15 or 134.12 or 134.10 and just expect it to get that far. Now, if you try to sell it short at 134.16, you're probably not going to get filled. Okay, it probably won't let you get in. So you can do that, obviously, to get closer to the daily high, or just simply use the sell stop below the Asian range to get in for model number 2. Once you do that, what's your protocol? You hold for Thursday's New York Open. It's just that simple. Okay, so you're going to hopefully collect 50 to 100 pips between your entry point and Thursday's New York Open. Now, what happens if you get 100 pips before Thursday's New York Open? You take it. It's simple as that. You scale off at 50, you scale off at 100, and you just let it go and see what it'll pay you out more to New York Open. At New York Open, I don't care what's going on. I don't care what I have tweeted about it. You collapse the trade. It's done. That's how you follow the model. You don't care what anybody else is saying. You don't care about anybody else's charts, no one else's analysis, no one else's opinions, especially mine. You stick to the pattern, the rules, and the model, and let it do its job. It's simple. So the next day, say you don't get this entry opportunity here, okay? What's actually happening is you're waiting for the rally above, and I forgot to mention this is the whole crux of this teaching. The usual opening price is down here, but many times you're going to see that after or during a reversal market profile, the opening will be up here, okay, at the 400 opening, and at 600 we're actually required to wait for that hour to open up because it's a little bit more clear. Now, you can actually use this as a filter going forward in your normal trading. You don't need to use the 400. I use 400 unless I'm in a reversal market profile. But depending upon how the markets trade, like we saw it here, okay, for instance, we have the opening price here, okay, right in here, right there for today. So the open on this was 133.63, okay, so at 400. That means, yes, you could have got in at here, but you didn't get in here on this rally up. But using the 600 or European Open, you obviously could get in at here, but then you also get it here. So it's just your filter. You want to be selling short above that opening price. You want to be selling short above that opening price. You don't have to do it this way. Again, you're selling strength. This is how you do it. But if you want to be a seller of weakness, again, use the Asian range, extend out in time, if price breaks below it, okay, once it breaks below it, it has to happen after 600 or European Open. That's the other filter. You want to see it happen like here's 600. It breaks below the Asian range here. So that's good. Here's the Asian range low. It breaks below it here after 600 or European Open, which is good. So you sell short on a stop here, and you use the high of the day here. Your stop goes above that. Now, you're going to find that many times the market may look like it's starting to tear off like it does here, and maybe it would have spooked you, okay? But it doesn't get to this level or just above it. The reason why 600 European Open is being used, and you're probably saying, well, wait a minute, it's really not that much difference here. I'm showing you this example here, and I want you to start studying every other instance in the future. And also study 600 European Open every single day. And you'll see many times it's more precise about where your Judas swing is to be trusted. In other words, it helps remove the ambiguity that comes sometimes using the New York Midnight Open. Okay, so especially when we transfer from standard time to daylight savings time, because some traders, again, use the time in New York, their models, okay, on a large fund basis are based on New York time. So it's going to be a little skewed because of that. I really like to use European Open right about the first 2 weeks when we transfer or transition from standard time to daylight savings time in the States. And it helps me refine my Judas swings where I can sell or buy based on this specific opening price. The standard deviations here using the expansion, you can see that we were looking for, or I was looking for, standard deviation 4 on this particular day here. It's 133.49. The high comes in, the low comes in at 133.49. So it went one pipette below where I was looking for it to go, created the low of the day. Here, again, same thing. I was looking for standard deviation number 3 on this day here, but I'm going to show you what I'm doing with this. Let me zoom this up here. The standard deviation 2 to standard deviation 3. Okay, let me show you what my settings are. Because you're probably, can you just show me what the settings are? This is what I got. I usually change this to central bank dealers range when I'm really showing you the central bank dealers range. But since this has been deviations of the Asian range, I just change it whenever it's necessary for your learning. But I just use the numbers interchangeably. I don't need it for my own personal charts because I know what I'm looking at. This is what I have. Now you have a video in the mentorship content that shows me giving you the levels that have the like 9.5, then 10, and 10.5, then 11. I don't do that because I can get more bang for my buck using it this way. And you're probably asking, well, what is this level right here? Okay, I saw this question on the forum, so you're going to get the answer here. This level is just simply the split, just like flout, because we do flout based on the 50% measurements. So in other words, if the flout measurement is the highest high and the lowest low, or the body's highest high and lowest low, that total measurement is flout, but we do projections based on the 50% of that range. So all this is the first projection of 50% of this range low to this range high. Okay, and I'll show you what I mean by that. Here is the high and the low of that range, right there. Here's 50% of that. Okay, so if I get a little box to show you graphically, it may not look like it, but all it is that measurement right there. Okay, so here's 50% of that. We'll take this away. Get rid of that box. Oops, don't want to do that. I'm going to get rid of not the deviations. There you go. So this box represents half of the range here. Now, if we break below this, that takes us right to that first level right here. Okay, that's all that it is. It allows me to keep my indicator clean, and it's also very mysterious if I end up inadvertently showing something on a Twitter chart or something like that. I'm afraid I'm going to end up sharing this stuff, by accident. So I'm doing recordings, and I'm always doing administrative work while I'm doing it sometimes, and I may flash a chart, and I may not catch it when I do my editing because I'm speeding up the chart that's hours long, and I'm compressing it all down into 45 seconds. So I'm aware that I may flash these types of things in the chart, and it's just going to be basically teaching. So what this allows me to do is this gives me 1/2 of this range here. And then I can visually see another half would be here, and then there's the standard deviation 1. So don't be thrown by the standard deviation 1 because that number ain't going to jive with what was taught to you in the core content. I do that because people, and I've seen a lot of these people do it, they go all the way up to month 11 and they quit. I don't know why they do that, but there's a lot of gaps even in the core content because that's why there's a charter membership. Okay, the charter membership, I drag that out too. There's a lot of content that I have to bleed out very, very slowly because there's Telegram chat rooms out there that are sharing people's content that got kicked out, and they think they're smart by giving out these PDFs and such. These PDFs aren't helping anyone. Okay, they're not. They just allow you a place to put your notes at when I give you amplifications of lessons. So when we have these levels like this, I can visually see where the mid-levels are. Okay, and if you want to get real precise, for instance, this daily low here, this is the low I was looking for to reach down into. This is where we hit a full standard, but watch what happens. It goes right to a mid-level. There's your mid-level there, and I'll drop it right on the 50%, and you'll see it nails the low perfectly. Okay, so it gives you your, I can see the mid-levels, okay, without needing to do all this. But if I want to get the actual level broken down to a specific price point here, that's all I do is I drop a fib on between standard deviation 1, standard deviation 2. Wherever the 50 level is, that's where I drop a line, and then I know what I'm looking for. So that's that. But we're looking for opportunities to hold again with these setups with shorts above the European Open after a potential turning point, which we got last Friday on your dollar CAD. We opened up the week before it even started trading with the likelihood that the dollar could succumb to its bearish seasonal tendency and allow foreign currencies to rally up. If you look at the seasonal tendency for Canadian dollar from your core content, it does have a rather slippery looking sideways consolidation during these next couple weeks, but then during April it really starts to tear higher with a seasonal tendency, and that would be bearish for dollar CAD because it's the inversion of the futures market for Canadian dollar. So just as a measure of completeness, we will look at this little moment in here. I gave you guys the price action entry or institutional order flow entry drill, how to get your entry prices. If you look at this little area right in here, same thing, this is a balanced price range. We want to look at the opening here. Why the opening here and not the bottom here? Okay, the opening price here is essentially the closing price on this candle. So we want to look at the close, the open, down to this candle's high right here, right there. Okay, you see that? Right there to this candle's opening. This is all sell side imbalance, buy side inefficiency. It's inefficient in its up delivery, or how price is going to go up. It's lacking that. Okay, it doesn't need to fill this entire range. Doesn't need to do that. Sometimes there's this common gaps that exist in price action. This is why I say that we want to use the 50% of that level. Okay, and you can look at the bodies of the candles. See that? Yes, we get this little errant price of a spike here. And I'm not trying to say that, oh, look at the optimal trading industry, because that's not what I'm saying. Don't get tripped up by that. We're focusing on the 50% level. Okay, look at the respect of the price action there. Again, the bodies of the candles are where the bulk of the volume is. We trade there, boom, open right there, doesn't trade any higher than that, it starts to roll right over. This, to me, is such a beautiful thing to see over and over and over again. Okay, I teach this as consequent encroachment. In other words, this is what we're allowed to expect. We don't need to see it go all the way up and close the gap. Okay, if we get straight up to that price point and starts to roll over, many times that signals a very stronger trade idea than if it was to go all the way up and fill the gap. In this case, it just says, okay, this is really, really weak. So since it can't close the gap, man, it's heavy. It's really, really heavy. Heavy being that it's very bearish. We have equal lows in here, so you could be a seller up here if you've missed this, using this as your narrative. We rated above the European Open, sold off aggressively, equal lows, Candyland, liquidity pool, sell side liquidity, sell short here, do your projections below. Alright, so we have our equal lows here, and here's 10 pips, 20, right? There, 20 pips. Bingo. We got one little wick down below it. Okay, simple. It spreads to that 50% of the standard deviation between standard deviation 2 and standard deviation 3. Okay, I think we'll probably see this trade tomorrow, that price level. But that's model number 2, how we use it with reversal market profiles. And you just simply look for elements that would support the idea, again, using the European Open as your filter. When we're bearish, we want to be selling short above that. If you don't want to be selling above it and you're bearish, you don't trust your ability to pick how far it'll go up, the easy man's approach or easy lady's approach to getting short is just extending the Asian range low when bearish, and your sell stop would be below that after 600 or European Open time. That's, again, we're not shifting time zones or nothing like that because of daylight savings time. Kill zones, we do not shift times with that either, okay? We just add one more hour to the back end of it. So in other words, if we've used our 11 to 13 for kill zones for New York Open, now it goes to 11 to 14. You just add an extra hour, okay? And like I mentioned in the mentorship, I just keep those extended hours as standards on my chart, okay, or at least in my analysis. I don't draw out boxes and represent, you know, kill zones and such in my own analysis because I know I'm looking for it and I know the time window I'm working in. But because I'm an educator and you're learning from me, I'm obligated to kind of like put those annotations on the chart, and that's the way you pick it up. I don't need to learn it. You guys need to learn it. So by me putting it on the chart and those lipsticks, help communicate when and where it's salient. So hopefully you found this teaching insightful, and we'll be back again in 2020 with an additional insight to this model. Next month, we'll be working on amplification for model number 3. Till I'll talk to you next time. Wish good luck and good trading.